All right, let's get right into this explainer. Today, we're putting on our detective hats. We are hunting for institutional footprints in the market, those subtle and honestly, sometimes not so subtle signs that massive amounts of capital are shifting right beneath the surface of everyday trading. I mean, have you ever caught yourself staring at a stock screen, seeing a volume spike so massive it literally breaks the chart, and wondering to yourself, okay, is this just retail hype from a random news headline, or are the massive institutions quietly making a move? History actually shows us that right before a big price move, trading volume almost always surges first. Now, before we dig into the actual market data, just a quick reminder, this is strictly an objective analysis of market activity up to August 2026, not a recommendation to buy or sell anything. Volume is a great clue, for sure, but it is absolutely not a guaranteed return. Always do your own research. Here is our roadmap for today. First, we'll decode high trading volume. Then we'll look at the August 2026 volume shockers, discuss when volume actually means selling, and finally wrap up with how to read these clues wisely. So, Section 1. Decoding high trading volume. At its most basic level, volume is just the total number of shares exchanging hands between buyers and sellers over a specific time frame, usually a single trading day. Think about it. If a stock typically trades, say, 5 lakh shares a day, and suddenly is trading 50 lakh shares, that's a 10x increase. That tells us something huge is happening behind the scenes. And as our sources point out, higher volume means better liquidity and smoother execution, which is exactly what the big players need to enter the game. Here's the kicker, though. Institutions managing thousands of crores. They literally cannot quietly accumulate shares overnight. It's impossible. If a giant mutual fund or an FII wants to build a position in a mid-cap company, they can't just buy it all in one day without sending the price into the stratosphere. So they have to accumulate slowly. But even doing that, they leave this massive footprint on the volume scanners way before anyone is talking about it on the news. To put that scale into perspective, just look at what happened in the first week of August 2026. Foreign institutional investors, FIIs, bought around 6,000 crore worth of shares. Meanwhile, domestic institutional investors, the DIIs, they were also net buyers to the tune of about 5,400 crore for the week. You add that up, and we're talking about a combined 11,400 crore of smart money flooding into the market. That absolutely set a heavily positive tone. Moving on to Section 2, the August 2026 volume shockers. All right, let's head over to our primary evidence board and see how all that macro money actually translated into specific stock stories. Just look at these three. Cello World, New India Assurance, and Deepak Nitrite. These guys saw their trading volumes absolutely skyrocket by 15 to nearly 66 times their normal averages on the NSE. I mean, that's not just a little blip on the radar, right? That is an absolute explosion of activity. So let's break down what actually caused this. First up, Cello World. This one witnessed a staggering 65.9 times its normal volume. Why? Well, the stock surged over 12% to hit an intraday high of 387 rupees. And this happened right after reports surfaced that the private equity giant Bain Capital is actually in discussions to acquire a majority stake from the current promoters, who, by the way, currently own a 75% stake. When global smart money like Bain Capital starts circling, institutional traders just rush in. And that's exactly what created that massive 94.5 lakh share footprint we saw. Then we have New India Assurance, which jumped almost 24 times its normal volume, with over 2.65 crore shares changing hands. The stock rallied 10% on the back of a major sector catalyst. Basically, the Supreme Court extended the mandatory third-party insurance coverage for new vehicles by a whole year. That kind of regulatory tailwind immediately pulled institutional focus right back into the general insurance space, triggering a massive wave of buying. Now, for specialty chemicals maker Deepak Nitrite, their 15.9 times volume explosion was entirely driven by fundamentals. Just look at this. Their June quarter net profit literally more than doubled, jumping from 30 crores last year to 65 crores this year. That kind of hard, undeniable financial performance is basically a magnet for institutional volume, and it pushed the stock up nearly 8% intraday. But it wasn't just those three. We saw heavy participation spreading across all sorts of sectors. Hindustan Copper saw volumes nearly triple to over 22 million shares, mostly driven by optimism around EV copper demand. Ola Electric jumped 3.4 times. Honestly, the smart money footprints were everywhere this week. We had huge volume alerts popping up in banking with IDFC First Bank, pharma with Laurus Labs, tech with Latent View Analytics, microfinance with Credit Access Grameen, financial services with KFin Technologies, and even electronics manufacturing with Kaynes Technology. All of this just proves that massive volume spikes can highlight powerful momentum across totally different industries. That brings us to Section 3, when volume means selling. Now we have to look at the other side of the coin, because just as massive volume can signal institutional buying, it can absolutely signal institutional dumping. It's a double-edged sword. Take this stark contrast. Cholo World had exploding volume and a rising price. Awesome. But then look at KPIT Tech. In August, the stock traded at nearly 360% above its normal volume, but instead of going up, the price plunged nearly 11%. Same thing with Jolly Food. It dropped almost 14% on a 250% volume spike. So falling prices combined with high volume, yeah, that is a terrifyingly strong indicator of aggressive institutional distribution. It basically means the big players are heading for the exits. And that leads us to probably the most critical takeaway from our sources today. It's perfectly captured by this rule. Unusual volume is not a signal to buy. It's a signal for attention. It just tells you where to point your magnifying glass. The volume by itself is totally neutral, you see? It's the context, the price action, and the fundamentals that actually gives it meaning. Which naturally leads us to Section 4, reading the clues wisely. So how do we put this into practice? Instead of blindly chasing a sharp rally just because a stock pops up on a volume shockers list, you've got to put the company through a 4-step reality check. First, objectively evaluate if the earnings prospects have actually improved, like we saw with Deepak Nitrite. Second, check those shareholding patterns. Is institutional ownership genuinely rising? Third, look at the business itself. Is it entering a new growth cycle? And finally, does the technical chart structure point to a longer-term uptrend, or is it just a one-day speculative spike? If all 4 of those answers line up, well then that unusual volume might just be your early confirmation that the smart money has arrived. So, I'm going to leave you with this thought. The next time you see a stock dominating the headlines and spiking on your screen, take a step back, ask yourself, are you just chasing the emotional price action, or are you actually ready to do the detective work and track the footprints of the smart money? Thanks for tuning in to this explainer, and happy investigating.